Hi, everyone, and welcome to part 2 of the weekly update this Christmas Eve. 'Twas the night before Christmas. The reason I'm doing a part 2 impromptu is because yesterday's one overran so much, it made sense to do a second update on the markets. So apologies, I'm just going to put some more lighting on. Apologies if this caught you a bit by surprise and it was unscheduled, but I'm hoping that you're happy to see me here and enjoying it all. Let's turn some bright lights on. That's better, isn't it? It's also quite a time to look at the markets in any event. So what I'm going to do is 2 parts to this. I'm going to give you all the stock market update that I didn't get a chance to do in yesterday's webinar. Let me know you can hear and see me loud and clear as well. And the second thing I'm going to do is, which I'm going to do first, is actually go through a quick run through of what we covered yesterday, but very quick indeed for those of you who are on it. Let me know if this is the first time on the webinar, if it's the first time on any of my webinars, and also if you missed yesterday's one. So it'll be useful to know either way which category everybody is in. Let me know where you're from as well. I can see some names from yesterday which are on today. Yogesh, for instance, I hope you're well. So first things first, let me just quickly I'm going to set myself 3 minutes to go through yesterday's webinar. Remember, this is not individual advice. Let me know you can hear me. Sound and picture good, yes. First of all, it's Christmas Eve, so it doesn't feel like it this year, though. It feels a bit too warm. I want more snow. Merry Christmas to you all. It's me at the London Stock Exchange a couple of weeks ago. Looking very festive, actually. I don't think that was the intention for them or me, but it just worked out that way. I won't go through who's on this webinar. You always know who's on it. My key focus for 2025 is getting more people to improve their pensions. That whole campaign that I have on campaignforamillion.com is going to take a bit of a jump up in terms of how much we cover as well. So that's sort of a big New Year's resolution for me, is to make sure more and more people are well aware of all of this and the things that I'm doing on campaignforamillion.com. I think that's going to be the key focus is that. So if any of you are worried about savings pension, whether you're in your 20s or 60s, particularly we've got a lot of business retirees and a lot of people who are time poor professionals, as well as, of course, people who've got tons of time as well. Now, so what I discussed yesterday, which, as I said, I won't go into too much detail, is we did a bit of a look back at the year, and Broadcom and Nvidia, of course, were two of the big giants. And I came up with all the way back in May 2023, when Broadcom was one of the ones on our private Telegram, and then January 2023, when Nvidia came up. And I said, look, Tesla was there, but so was, and Live Nation this year is at all-time high, but so were global payments. I don't know how that's gone. And Disney was incredibly volatile and not fantastic. So why did I not just mention Nvidia? Well, because we didn't know it would be the start riser. That's why we don't just pick one company. It's why we have a portfolio, i.e. more than one, by definition, for that reason. And then yesterday I took people through how poor the performance of these funds are. And if you've got any of these, please be careful, especially if it's St. James's Place, Fidelity 91. Please be careful, because as you know, pension fund managers underperform because they spray and pray and they can't hold cash in poor years. I will later on in today's webinar, we didn't get to it yesterday, is go through some of these ideas, for instance, from Goldman Sachs, incorporating them into what I'm looking at in particular. So I'm running through the review really quickly, and how my goal is always to share with you, for instance, things like this. UBS rich clients get Goldman PIMCO strategy with an extra free. Is when I get those strategies, when I get them from hedge funds, and we'll discuss this in this webinar because we didn't get a chance yesterday, I'll share them, the ideas and what they're doing, how they're doing it with you as well. This also, I mentioned yesterday, caught my eye. Profits are going up. Earnings means profits. The reason US markets are rising compared to the rest of the world and the total return is going up is because the profitability of American companies is going up. Now, I think that's going to get more and more exponential. Obviously, it can't keep going exponential forever. There'll be a cap. But it's almost like American companies, with the amount of capital they've got, are at a takeoff stage that we've not seen previously. You can't compare what's happening today with what happened in the 1960s or 70s. It was a different world, or even the 80s. I'm not saying it's different this time. What I'm saying is, as long as you've got profits, okay, then you can justify higher prices. You can't do it as like what happened in the dot-com boom and crash because there weren't profits, or in the financial crisis because there weren't profits. Okay, well, actually, the financial crisis was a problem with assets. The assets weren't worth anything near what people were saying. We don't seem to have those two problems. COVID crash happened because there was a lack of cash flow. All companies have three sets of accounts: profit and loss, cash flow, and balance sheet. Crashes come from one of those three sets of accounts. Either there's no profits, that's the dot-com bubble. There's no assets, that's the banking crisis. The assets your house wasn't worth as much as people were putting onto it, okay? Or there's no cash flow. That's COVID. If you shut down an economy and say you can't buy and sell stuff, doesn't matter if you've got lots of assets and lots of profits, there's no cash flow. The only things that can cause a crash, because think about it, what's a crash? Well, it's a revaluation of your company. Why would your company get reevaluated? Let's look at the accounts. What are the three types of accounts? Cash flow, balance sheet, profit, and loss. The crash can only come from one of those three causes, okay? Now, at the moment, assets seem rightly valued, don't they? You tell me, am I missing something? Okay, profits are there, and cash flow seems to be coming in, okay? So I'm relatively relaxed and pretty happy with all of this. Thank you very much. Oh, Ravi, my friend, thank you. Looking forward to coming on board. Stuart, I'm looking forward to welcoming you on board as well. Now, one of the other reasons why I'm buoyant. Now, remember, now this is really important. Unlike a stockbroker or an IFA or a wealth manager or a fund manager, I'm not trying to sell you my retail fund. So I don't care if I have to hold cash. Like in 2022, I just said to you guys, well, my son and I are holding cash in January because we can't find anything good to buy until February. And then February, well, we're still holding cash. This is 2022 until March. In March, we're holding cash. And that year, the markets actually ended up going down 25%. We didn't know it was going to go down that much because I can't see into the future. I don't have a crystal ball. I just said I can't find something nice to buy, so I'll just hold cash. Because I'm not a stockbroker where, oh my God, I better tell them to keep buying and trading and be optimistic. Okay, I couldn't care less whether we're optimistic or pessimistic as long as I'm making money. Okay, so when I say to you, year one and year two, S&P was up that much, and usually if you get back-to-back gains, the third year should be positive. Personally, I couldn't care. I mean, I hope it is because I like making money, but if it isn't, it's out of my hands and I couldn't care less. The reason is, if it drops and I say, listen, guys, I'm holding cash, I'll tell you I'm holding cash because I don't have a conflict of interest to lie to you. IFAs have a conflict of interest to lie to you because they need you to keep invested with them so they can earn the fees and send their kids to private school. Fund managers have a reason to be optimistic and lie to you because if you take money out of their fund, guess what? Now, don't get me wrong. If I had a $10 billion fund and I was receiving $100 million in fees every year from you, 1%, I too would become like a politician and corrupt and say to you, oh no, stay in my fund, we'll be fine, we'll be fine. And I wouldn't say to you, you better go into cash. Fund managers can't hold cash, okay, in case you thought they could. This is why it's very easy for me to pick on fund managers and say they're rubbish because they've got their hands tied behind their backs. I can say they're rubbish because they can't do two very important things you and I can do to get better performance. You and I can get better performance by picking from the whole universe of stocks. They can't. They can only pick from either UK ones or Chinese ones or American ones, depending on what their remit is. And they can only buy into the biggest companies because, which has been pretty much okay, biggest companies, because they've got so much capital, they take over anything smaller than 10 billion usually. All right. You don't have that problem. I don't have that problem. Okay. And they can't hold cash. Right. So when I'm always criticizing St. James's Place, in a way, I'm cheating. Because it's like criticizing, it's like going on a football pitch and criticizing my 6-year-old son and me saying, you're rubbish, boy. I'm so much better than you. Well, yeah, because he's handicapped by age and he's tiny and I can push past it. Same with St. James's Place or anybody else. They're rubbish because they can't hold cash. So when the market falls like in 2022 and we can hold cash or you can hold cash, they can't. They've got so much capital they can only buy into big companies through the funds they recommend. Thirdly, they'll never tell you to get out of their funds because they've got a conflict of interest. And fourthly, those fund managers can't hold cash, they are restricted by what they buy by geography or their remit. Okay, so I just wanted to give that context to you on all of this. Then yesterday we discussed this, 2 million views as of 2 days ago. Yay. UK GDP, I won't go through this again, why it flatlined. Of course it bloody flatlined. UK GDP is flatlined. What do you think is going to happen to our stock market? Could go up, could. UK stock market could go up. But the UK has said we're going to increase taxes and we're going to cut government spending. All GDP comes from 3 sources, okay? 3 sources. Consumption by you, private investors, investment by corporations, and government spending, okay? Money comes from those 3 places, right? Businesses, well, you tell me, are they going to invest more or less over the coming year? Well, if they've been told your employer national insurance contributions have gone up, Mr. Business, and corporation tax is staying at 25% for the next 5 years, you're thinking, well, thanks a lot, bloody hell, better save more money, I'm not investing. Consumers being told, well, guess what? We haven't got much money, outlook looks pretty shit. Consumers aren't exactly going out. I'll tell you where consumers are spending. British consumers are getting on planes, going abroad to Dubai and spending like crazy abroad. Well, thanks a lot. Doesn't help the British economy. They're basically taking the money and shoveling offshore. What they accuse the rich of doing. And government spending, well, we've been clearly told there isn't any money, so that's going down. No wonder GDP's fallen. Doesn't take a bloody rocket scientist to work that out. Whereas what the Americans have said, we're going for growth, okay? I mean, don't get me wrong, British politicians say we're going for growth as well. It's just that it sounds more credible coming from the mouths of Elon Musk and Donald Trump, billionaires that are being appointed across their government, than it does from British politicians who say we're going for growth. You tell me what sounds more credible. And economics is about credibility. Stock market is about credibility. Okay. So that's another problem we've got is, doesn't mean the UK market won't rise, could do. But if your pension fund stuck to the UK markets, I'm afraid you are somewhat, what's the technical term they taught me at university? Screwed, okay, for the foreseeable future on that, which is why I want to teach people. That's why I want to teach people, at least to know this, if nothing else. This is what the Telegraph said. Now, the Telegraph are obviously going to have it in for Rachel Reeves. But nevertheless, the problem with pensions I mentioned yesterday, I'll put that up on YouTube. Okay, I'll put yesterday's video up on YouTube, so don't worry. And I also shared some of the returns that some of the new students have got on the program. So yeah, the banks are positive, but the banks are always going to be positive. I mean, well, not always, but it's nice to see. It's a nice environment. I'm going to say my pension should be up by 1/3 over the next 2 years. And I'm cheating by saying that because I've taken a 2-year period. Why not 1 year? Well, because it's easier for me to take 2 years. Also, because I think in one of those 2 years, we should get something of a pullback. So what? And I don't know whether it's going to be next year or the year after, but one of those years I think is going to be not so great, but the other year is going to be phenomenal. I just don't know which order they're going to come in. So I'm going to say up 1/3 over the next 2 years as well. And it'll come from, obviously, those selections that I make on the program. Okay, so I discussed this yesterday. And one important thing I want to just repeat again from yesterday's webinar is, in one sense, my job is to tell you when to hold cash. Now, I know it's Christmas and a lot of people do their favorite reading list and favorite movies. Can I just say, at Christmas, one of my favorite movies of all time, financial movies, is Margin Call. And in it, Jeremy Irons, who just gives the best acting of his life in that play, although he's pretty good in Damage. Jeremy Irons says, as chairman of a bank which is about to collapse, says, my job is to hear the music. And right now, I can't hear anything. His point being, my job is to keep us out of trouble. My job, in one sense, is to keep us all out of trouble. It's to say in years like this, 2022, we should be holding cash. Let's say I don't say anything to you the rest of the time, and I just say to you, just track the index the rest of the time. And I only tell you when to hold cash. So I only speak to you. Ravi, my friend, you're on here, so I'm going to address you you're on the program, so I'm going to address you. If all I do is speak to Ravi once every 7 years, roughly, and say, this year, stay in cash, and that's all he ever hears from me, and he avoids these deeper falls. Might not avoid it all, might be down 3% or 6%, but avoids the bulk of it. And the rest of the year, he just tracks an index. For all my effort to give him good stocks, explain the markets, he just ends up bloody tracking the index. Ravi's going to be happy. Okay. Now, if I can then incrementally say my role is not just that, but also just try and eke out how we can do a bit better than even the index. We'll be happy with the index, but let's say we do a bit better, okay, by taking some of the outperformers, basically, forget the outperformers, just removing the ones which are overvalued, not growing companies, because the overvalued, not growing companies will probably be pretty stinky, okay? And so we take the S&P 500, we look at the whole list of stocks, and we just remove the ones which are overvalued. As an example, I'm just giving it. Then we might get these greens to be even a little bit higher. But that's even if we're being greedy. Let's say we did all that effort and we couldn't. Well, at least we stopped the falls. And in terms of stopping the falls, as Ravi knows, one of the things we do, or I do, when I tell the clients that, just make sure you can all still see me. Here we go. You can all see me. Oops. For goodness sake. There we go. Is that part is just when we're looking at average short and medium term prices, and if they're declining, then we know from past experience that we don't want to be in. So in a way, my job could be really easy. I could say to Ravi, listen, mate, I only need to speak to you once every 7 years. So anyway, that was a very key important point I made yesterday. Of course, it doesn't always work out. The danger of then not doing the index is this can happen. CVS was one I asked. I've always joked, Donald Trump does a tweet and a stock could soar or drop. That's the risk of individual stocks. So increasingly for 2025, one of my resolutions is to make sure that my clients know, guys, there's 7,000 funds, exchange trade funds, not the active St. James's Place kind of rubbish. I'm talking about basically index trackers. And a lot of those do better than the S&P 500 with less downside volatility than the S&P 500. Okay, so even if your job was, well, I just want to beat the index. Can you beat the index? Yeah, well, why don't we just do a tracker which actually beats it year in, year out, every year? Now, I could cheat and rewrap that and call it the Alpesh-Patel fund and charge you an annual fee of 2% or whatever. But I don't need to. I can just tell you these are the exchange traded funds which outdo, and I'll probably do a separate video on that actually, because we've got the data. If you don't have the data, and I want to pull up some of this data. Okay, if you don't have the data, and this is critical, in anything, if you don't have the data, you can't do it. The other thing we try and then do is save people a hell of a lot of time by saying to them, okay, here's the data. What we're going to do is we're just going to put it into a PowerPoint for you. You've got all the data, so you've got transparency and control, but we'll give you the PowerPoint as if you are the chairman of your family investment company, and we will give you the data. None of these are good enough to be in my pension, okay? By the way, because they're not green across the first 5 columns. We make it very simple for that reason. But even then, you're not guaranteed a rise because Donald Trump isn't a column in there. Is Donald Trump likely to tweet on it? The reason we have more than one stock is because you never know what Trump's going to tweet. For all I know, Trump could say, I think Microsoft should be broken up and it should be bankrupted. We don't know. The man might say that. That's why I don't just have Microsoft stock. Okay. Broadcom we mentioned, which was one of the AI picks. So I said, do I take credit for that? Well, actually, it was an AI pick from last year, and I didn't know it was going to soar this year this much. Why did it happen? I'll tell you why it happened, and this is something I really want to repeat today as well. I don't know if you know who Trump's new, actually I'll be shocked if any of you know this, new AI policy supremo is. Okay, it's actually somebody my wife worked with. It's a guy from Andreessen Horowitz, which is one of the biggest VC firms, and he was in the UK until very recently. Just want to make sure, let's close this window. I've got too many windows open. Excuse me while I close some of these. Okay. And what he did is Trump got him appointed as the AI supremo. And that's what's led to some of these stocks just absolutely soaring as well, was because he's been appointed in that role. She knows him. And I'll tell you something. I'm going to give you, this is not confidential. I can't give you anything confidential, obviously. There's two things. The VC community, contrary to what the mainstream media tells you, is all over Trump. They love him. Okay, Anderson Horowitz, who are behind some of the biggest successes, love him. I've never seen anything like that in politics. Maybe not since the 1980s when I first started buying privatization shares in the UK. Have I seen business love a politician this much? So when he says pro-growth, the media, I've never seen the media hate somebody so much. The mainstream media. The legacy media. My job is to sniff bias. I couldn't care less what my personal views are about Trump. My job is to make money. Okay. A mentor of mine was the chairman of the London Metal Exchange, Lord Bagri. He passed away, sadly, a few years ago. His son said to me, they have the house in Regent's Park, Outer Circle, next to the mosque. Actually, both houses next to the mosque, Ionic Villa and the one next to it. And it used to be the UK's most expensive residence. The reason I mentioned this is the son, who used to be my best friend, said to me, Apu, said to me, these were his words, "My job is to make money for this family." That was it. That's all he said. He said, my job is to... I was shocked. I was thinking, shit, nobody ever says it that openly and expressly who are doing it. You know, you might say it when you're a student, my job's to get rich, or on TikTok, but nobody bloody actually says it. The reason I mention that is I don't care about personal biases I have regarding politicians or not. What I care about is, can we make money from this? I'll do my charity work. I will go to the temple and absolve my soul of sins and so on. But it is to listen to the music. But I listen to the music by looking at the data, so my personal biases don't come into it. I am not, contrary to what people might think, a possessor of a crystal ball or seeing into the future. I will look at the data and say, is it all green? Okay, so I spent too much time on yesterday's one. Okay. So there we go. That's where we are with this. So it's looking positive for next year. I'm just running through the slides from yesterday really quickly. The money's going into the US. It's really not going elsewhere, I'm afraid. Okay, net inflows into equity funds. There's a lot of cash which has been sitting on the sideline. So all of these things are positive, but this doesn't mean I put my feet up and say, right, we're going to make a killing. Somebody had messaged me, one of my students, just before this message, and he used the word excitement in his email. I said, well, if you want excitement, just do 3 times average S&P for the next 2 years. You might get a heart attack in between, but you know, excitement's not what you want. It has to be controlled. Because it has to be controlled, we don't just have one stock. And I want you to always keep an eye on your maximum draw and maximum loss potential, i.e. whatever you pick, whatever you might pick, this is a student of mine, whatever you pick, make sure you've looked at what the drawdown, previous drawdown, what's a drawdown? It's where the stock has fallen from peak to trough. So the drawdown's that bit. Historically, how much has it fallen? Okay, and what loss would that entail for the amount of money you're putting in? That might then let you see, oh God, I don't want to put that in if that happens again. So you're not relying on hope. That's money management. Money management is critical to success in investing. Okay, and I'm going to show you how we know this. Okay. And I'm not just telling you today, because if you look at the Financial Times, you look at this young man. Where's he gone? Alpesh Patel, 2004. I've said that 20 odd years ago. Okay. 20 years ago, I've been telling people money management is key to successful share trading. Okay. Forget headlines and Tesla's you must buy now. Contrary to what people think. It's 20 years ago. I'm still having to tell people. When are we going to have to stop telling people those things? Okay. Wells Fargo also positive. Sadly, London Stock Exchange shrinking. Okay. Christmas is coming. You want my list of movies? The Big Short. That's another one. Okay. I don't have a cameo role. I wish I did. But The Big Short, you'll remember from The Big Short if you've seen it. It's a great finance film. It'll explain the financial crisis. It's so watchable. Aaron Sorkin wrote it. Okay, so my list. Now, going back to things. Number of hold. Look at this. Even the Indians are getting into it. Hey, Ravi, 179 million accounts. That's double the population, man, woman, and child of the United Kingdom, okay, who've got stock holding accounts. By the way, don't think that's got nothing to do with the US. Almost all of that money will be staying in the domestic Indian market. But here's what's interesting. Now, put another way, this is from Bloomberg, where I used to have my show. So I really like Bloomberg. I am biased towards Bloomberg because they are the best financial services company in the world. Okay, or financial media company, rather, in the world. Second to none. My job in many ways is just making sure, well, actually, even this, just making sure those 6 times it drops over 5%, we have the brakes on. Okay, that's it. And the rest of the time, my job is to do nothing. It's to do nothing. It's just let the plant grow and grow and grow. It's what Warren Buffett says. He goes, most of the time I do absolutely bloody nothing. Okay, and that's the job. Right. This is an old one from my son going back in, I think, 2019. Just because people ask me, what's in your son? And I say, well, actually, he has about 5 holdings, and that's about it. This isn't now. He doesn't have Premier anymore. He still has Apple, Amazon, Globant. He doesn't have at the moment, but it'll be one he'll be going back into at some point. The point is, with his junior ISA, just so people know, open a junior ISA for your kids, New Year's resolution for you all. And secondly, you can keep it relatively simple because there's less money you can put into it. That's why it's not going to have 20 stocks in there. This is one of my students, joined 15 months ago, is up 60%. But then again, the market did well. I will, that's from one of my old columns, right? So I'm not going to read all of this for you. This is another student who went from 100 to 400, although he added a bit of his own capital in there. So let's get on to this market update. Okay. But this was last time. So that's on yesterday's one. This is from Mithun. Ravi, that's Mithun, who you know as well. That's him at the airport on his honeymoon. On his honeymoon, one of my students sends me a picture and says, I'm watching on my iPad or whatever that is, on his flip phone, your broadcast. And I'm thinking, mate, you're on your honeymoon. I don't know how long this marriage is going to last. Anyway, whoops. So I did all of this yesterday. So please watch yesterday's video on YouTube. It'll come up later. And let's now do, and I want people to have an Excel like this. This is one of my other students. Let's now do the stock market update. So let me go. And by the way, this poverty gap is going to increase between the US and the UK pensions. UK pensions will continue tracking and underperforming the UK markets. This is the last 10 years. And they'll get you 41% over 10 years. You work your ass off working or in your business, whatever else you're doing, and you're retired, you have loads of time on the golf course, and that's all that's growing. Whereas the Americans have grown tenfold. That gap, one thing I will guarantee you is that gap's going to get wider. And you're going to say, well, bloody hell, mate, you paid for your education, did you, Alpesh, to tell us that gap between the US and the UK markets is going to get wider? It doesn't take a rocket scientist to tell us that. No. Okay. That's why I want more Brits, and I'm on the campaign to get more Brits to invest in US equities. And I think I'm the only person in the United Kingdom telling anybody to do that. Okay. I have mentioned it in my books previously. Okay. I don't know if you can see the book over there as well. I got this just yesterday and I posted it as well. This is phenomenal. 65% over 2 years. Not all students get great returns because some will want lower volatility. They'll want to hold a lot more cash. So it'll be lower. But the important thing is they manage their own capital. This is from Goldman Sachs Asset Management. I won't, again, go through it at the moment, or this because I did it yesterday, on why we have 20 to 40 stocks. Okay, what I want to do is move right on to, and you can download the book from there. Right, stock market update. Here we go. Perfect. It's overvalued. You know that anyway. You are paying $28 for every dollar of Microsoft's future profits. That's what that means, okay? You're paying $30 for every future expected dollar of Apple. But it's been like this for the last 10 odd years, okay? Because valuation is not the only thing, i.e. how much you're paying for a dollar of profit is not the only thing which moves stock prices. Expectations of future growth are. Cash flow is. We know this from the academic research done. And when I used to write the columns in the FT, and then actually I've published a whole load of them in here as well, the academic columns, I'd look at what was coming out of academia and it showed that, well, as you would expect, valuation is important, growth is important, dividend yields are important, and a big database to start off with and then filter down is important, so you don't have any poor performing rubbish companies in there. So we're going to have a look at all of this in a second. There is absolutely nothing happening in the earnings calendar of any importance. Okay. What I will say is we narrow it down, make your lives easier by, as you will know, making sure, are these first 5 columns green? Croakey comes from Goldman Sachs Wealth Management. Value growth income comes from Nobel Prize winning economists Eugene Fama, Kahneman, Richard Thaler's work, amongst others. Okay, this comes from Momentum, and the hedge fund industry. Sortino and Alpha come from the hedge fund industry as well. So how's the market been? Well, it's had a bit of a pain actually recently. This is slightly this is not bang up to the last 7 days, but it's roughly the last 7 days. Okay, the past year, however, now I think over the next 2 years, I can't guarantee this, but I think over the next 2, not one, over the next 2 years, we're going to get a similar map to this. Not 1 year, last 2 years, next 2 years, okay, where I think we're going to get, now I'm not saying that means Amazon's going to go up 45%, they might, or Apple 26. What I'm saying is if I have a basket of stocks, let's say I just get these, I should probably come back to this video and just say, well, I'll just buy these. Okay, I think it'll be, you know, it might be Apple is up 58 and Oracle's up 26. They might swap places, but my point is that'll be the mixture of returns. And there'll be some which will drop like 27. I'll think, how the hell did we get that? Or an Intel or whatever. They won't all go up. I can guarantee you that. Whatever I select, if I pick 20 stocks, they won't all go up, because even in the very best year, 2023, one of them dropped out of that 20 that was negative return. I'm thinking, how the hell? That's a year where we had Nvidia in there. We still had a negative one, which is on the website. If you look at alpeshpatel.com/shares, you'll see it on there, the performance. ETFs, I'll do a separate webinar about. So where are we on valuation? We know we're paying $32 for every dollar of profit for US stocks. We know we're paying $32 for every dollar of profit in US stocks. Is that expensive? Well, does it matter? Yes, it's expensive, but that's why we do. We keep a close eye on everything. What's interesting is, yes, market capitalization has gone up 28% because profitability has gone up 10%. You might say, well, wait a minute. That's what's called PE inflation. If earnings have only gone up 10%, but market cap's gone up 28, it means people are willing to pay more for what is essentially the same thing. Imagine you're renting a property and you earn $1 a year from that property, and you're now willing to pay $32 for it instead of $28. Well, that's asset inflation, PE inflation, which isn't good, but at least profits have gone up. And here, revenue or sales have also gone up. Look at those numbers. The total market cap of the United States is 63 trillion. The size of the US economy, I think, is half that. US economy size, okay, is, let's see how good AI is. It's 30 trillion, so it is half that. Okay, so the market cap of the US is double the GDP, the annual output, basically the market value of all goods and services produced in the country in a year. So it's expensive. Price to earnings, if you want to look at individual sectors, which I don't, and the forecasted growth. Forecasts tend to be over optimistic, so be careful. What you want is ideally this to be as low as possible and this to be as high as possible. That's when you know you've got an undervalued high growth company. These are sectors. I don't particularly care for sectors, but I'm just sharing this data with you because I look at companies and I want the individual companies to be undervalued and high growth, dividend yielding, high cash flow, cash return on capital invested. But that's time consuming, Alpesh. No, it's not. Just get the database to do it. That's it. I just get the database to do it. And then it's not time consuming. And then I go and play with my 6-year-old son. That's become incredibly more important since I became a dad, for obvious reasons. Now, US market, how's it done over the last 7 days? Well, over the last 7 odd days, roughly, these companies, 1 year, okay. I'm not reading anything into this at the moment. These are not selections or anything. I continue holding. We had it earlier in the year because Accenture should be benefiting from the AI, but it's really not converted it into returns, as you can see. I might do at some point the consultancy. It should be an AI play, but it's just not followed through. Boeing not had Tiva. Okay, this is the UK, however. It is cheaper. 19 times you're paying. For the same $1 in profits, or £1 in profits, you're paying £19. Okay. However, why? Well, for a start, and by the way, the market cap of the UK is 2.4 trillion. So what is that? Well, it's small. That's what that is. The UK economy is, are we about 5 trillion roughly? UK economy GDP. There's a reason this is important. No, it's 3.4 trillion. Aren't we? Oh, we're only 3.4 trillion. Okay. Now, the reason that's important is our stock market isn't. Oh, okay. No, we're 2.5 trillion is the UK economy. So our stock market is roughly the size of our GDP. In the US, the stock market is double their GDP. So the Americans are creating a lot of wealth through their stock market. I'm less worried about the size of their economy or the size of their national debt because the amount of wealth they create. Anyway, there's a problem. We're not creating profits. Our profits are down. Our revenues, sales are down. Those are not good numbers. If I was the CEO of a board and my board came to me with this, I'd be furious. I'd say, what the hell? Profits are down. Well, obviously profits are down. You're going to have more expenses next year, both in terms of corporation tax and employer national insurance. So those earnings are only going to go down. Okay. And sales are going to go down because people have got less money, which makes it very difficult for market cap or the stock market to go up unless you get some big price inflation. I don't see the world shoveling a load of money into the UK stock market the way they are in the US. So I don't see PE ratio inflation, right? Those are some of the price earnings ratios, and those are some of the forecasted growth. At least there's some forecasted growth, which just shows you how insanely over optimistic fund managers are or analysts are because they just want you to buy stuff. Over the past, I use Wise, 7 days, 1 year. Okay, so not everything's bad. This is, by the way, IAG, that's my comment to you about you Brits are going abroad and spending your money. You're dumping a load of pounds abroad. You're force feeding the rest of the world your pounds as tourists. You're not spending it on the high street. You're going abroad. How unpatriotic are you lot? Whereas I'm buying assets abroad, like Microsoft shares, and as those Americans work for me and give me money and profits, I bring it back to the UK and spend it in the UK at Lidl and the like. IAG. Okay, so there's this. Exchange traded funds are overlooked. Exchange traded funds are overlooked. I'm not going to, I'll do a separate one on this. I think they're overlooked because people don't think they can get the returns. They don't give good returns. They potentially do. And so we're going to do more of this in the new year. So again, New Year's resolution with Great Investments Program, I'm going to do a lot more on exchange traded funds because I think, especially with an overbought market, which is expensive, it makes a lot of sense to focus a lot more on the less downside volatility as well. Thank you, Carwin. I'm glad that worked. Santosh said, is it not best strategy to invest in UK stocks that can benefit from Trump 2.0? Santosh, is it not the best strategy to invest in US stocks which can benefit from Trump 2.0? Okay. Market year to date. If you can name me any UK stocks which will benefit from Trump 2.0, let me know. But I wouldn't be looking at the Trump trade alone. I'd be looking at undervalued companies with high growth and good dividend yields. So what I'd be saying is, well, doesn't it make sense? Instead of coming up with a theory, why not just have the tried and tested theory, which is undervalued companies with high growth and good dividend yields do well? And when we filter those, because we've got London Stock Exchange in there and NASDAQ, New York Stock Exchange, guess what? Hardly ever any UK companies come up. Okay, hardly any. Let me tell you which UK ones ever come up at the moment. Okay, PayPoint comes up out of the UK. I don't know whether it's Trump or not, Baltic Classifieds Group. PayPoint and Baltic Classified Group. You know, quite like Walmart and Costco. Markets year to date, right? It's been good. We had obviously that fall off. This is the markets year to date over there. But look, in the UK, you got a little bit more than bank interest for all the volatility the stock market gave you. Okay. And all right. That's what the US stuff had done. You know, in your SIP and ISA, you can have US stocks, Santosh. PEs are cheaper for UK stocks. Yeah, because nobody wants to pay for them. Nobody wants to buy them. PEs don't pay. Go to Starbucks and say, I'm going to pay you with my cheap PE ratio. They'll say, actually, sorry, sir, we take cash. They take money. They don't take PE ratios, unfortunately. But you know, in your SIP and ISA, you can hold these stocks. The thing is, and rightly so, some people are wedded to British companies, and no matter what, they won't let go of them. And that's fine. You will get a lower return, which is fine. You know, some people they actually do, I come to the conclusion, do want lower returns. Not everybody is greedy, Alpesh, and wants to make their pension grow significantly. Many people are just happy with bank interest and beating it. Somebody had told me this on TikTok. He said, look, some of us just want to beat bank interest by 1 or 2%. It's a very British mindset. Okay, I have a very American mindset, which is, how do we go to Mars? How do we shoot for the moon? How do I ride the coattails of a 40% S&P? A very British mindset is, okay, how do I beat bank interest? And let's just keep it sedate. Okay. These are the factors which have been moving markets: value, growth, momentum. What we do is we look for stocks which are growing, which are and a subset of growth stocks which are undervalued, and a subset of those which are showing momentum. So there's very few we can pick. Doesn't mean the others won't go up. Trump might do a tweet and the others go up as well. There's random stock movements all the time, but we don't do that. For my son's junior ISA, I only want companies which are growing and are undervalued. You might say, well, it could be a rubbish company that's growing and undervalued. Listen to yourself if you think that. Okay. And we want to get in there. In many ways, look, it's Christmas. It's a bit like multi-faith. Warren Buffett and I are both taking the same path. We're both taking different paths to the same God, the God being market returns. He's taking a slightly different path. I'm taking a slightly different path. Mine's value, growth, income, cash flow, Sortino. His is value, growth, income. Oh, actually, it's pretty much the same. Okay. So he puts less emphasis on momentum. I put more on momentum because I come from a hedge fund background and I've seen it work really well, and the academic literature supports me. He puts less on. Okay. I'm closer to what Jim Simons does, who is the best performing fund manager in history, who is very much more momentum emphasis with value and growth. And anyway, it's not what I think. None of this is what I think. All of it is based on. All of it is based on. Better make sure you can all see me. All of it's based on the spreadsheets. So we look at the spreadsheets. It's all based upon that. Okay. Now let's go a bit more into this. Markets of the past year. Well, obviously year to date and past year look the same. All right. These are the FTSE 350 rises. So it's not to deny stocks can't go up. In the past month, this is what's happened. Okay. They've gone up. It's not to say all companies are rubbish on the UK by any means. Look, there you go. Some of them have gone up. Where are we on the S&P? Well, that's been the recent falls. Put it into context. Nothing. We are overbought, and that worries me. But now here's an important thing. People are very premature to panic in the markets. Okay. So I know that we could drop, but today's not the day for me to exit. How do I know this? Because this isn't happening. We're just here. So I'll just wait. But why do you panic now, Alpesh? Panic early, panic early. No. Most of this year, I've had to do nothing. Nothing. Even when these falls happened, what we call a mama bear, not baby bear, which are the smaller ones, there's nothing for us to do because it hadn't fallen enough. Same with NASDAQ. Okay. Still rising. I appreciate this is, by the way, a measure of average, short and medium term average prices. Okay, that's what this line measures. And if short and medium term average prices are falling, then you get a pretty good idea that the market's going to continue falling. It's pattern recognition. Just look at the pattern. It's not guaranteed. Nothing's guaranteed in the market. Somebody emailed me and said, can you guarantee? And I was thinking, well, let me stop you right there. Anybody who tells you they can guarantee, I can't guarantee if I throw this in the air, this little hand grenade, that it'll fall. Because I don't know if you know this, from my physics, I recall being shocked that gravity is just a theory. What that means is there is no guarantee it will keep working. I didn't know that. I don't know. Speak to a physicist, they'll tell you. FTSE 100, where are we? Well, we are not too far from where we were in 2019, so 5 years of that. Looks like there might hopefully be a base. Look, God willing, it'll rise. I don't think employers want that to rise too much. And I'll tell you why I don't think employers want it. Because employers know that employees, were they to make the kind of money they do in America, they'll probably quit their jobs earlier because they'll take their pension earlier and they'll say, bugger this, I'm off. My pension's up. Most people in Britain have to work longer and longer and keep paying tax because their pension hasn't grown. Employers want you to do that, and the government wants you to do that. I'm not saying it's an out and out conspiracy, but let's put it this way: employers and the government have absolutely zero incentive in making sure your pension grows too much. They just need you to have enough that you're not going to be in poverty, but not so much that you quit your job too early. Because if you quit your job too early, you're not going to be paying tax. Okay, you're getting spending money, which is fine, but you're not going to be paying tax because you're not earning. And the employer has a problem because they've got staff problems then. All right. So that's where we are with that. S&P 2 times average, as you know, I've got. If you don't understand leverage, don't even go near it. It's high risk. Don't go near it. I appreciate there can be volatility on this. Rather, you know the volatility on these things, but you gradually realize how much volatility you want to take. S&P top 10, this is the past month. These are the ones which moved the most. Now, let's be absolutely clear. Did I know Broadcom was going to go up? No, I don't know anything. Let me say that again. I don't know anything because I don't have a crystal ball. What I know is if value, growth, income, cash flow, Sortino are there, and we pick 20 companies ticking those boxes, or funds, we pick enough of them, then we should be all right. And in that, some of them will go for the moon, others won't. There'll be a real disappointment. I'll give you an example. CVS, immense. If I look back on the year, immense disappointment. Disney, a little bit of a disappointment. I really thought it was going to do better around January, February time. I even had a little argument with my sister over it. She said, NVIDIA. I said, well, I've got it, but I think now it's time for a bit of Disney as well. She said, nah, NVIDIA. So, and she was right. Okay. 7, Broadcom, overbought. This is common with what's happening in the market. So we're very cautious in that it's overbought. And basically the same rule we applied for NVIDIA. If it drops X, sell Y. X is easy to do. If it drops X, sell Y. What does that mean? If it drops, say, 10% or 15 or 20 or 25 from the high, sell Y. How do you work out what Y is? Well, you could work it out in hindsight. Well, that'd be bloody useless. You work it out based on your risk appetite. You work it out. That's easy. 10, 15, 20, 25. If it drops X, sell Y. How much you sell is based upon your risk appetite. Because in an uncertain future, the only thing you can control is your decision-making based upon your risk appetite. What people try and do is predict the future, ignore their risk appetite, and when something then drops too much, they panic, either sell too soon or too late. This is one of the few which isn't overbought, okay? Isn't overbought, is Tesla. Costco, again, overbought. If it drops X, sell Y. Netflix, not one I own, by the way, Netflix, but it's one I've been covering since I think since this period, since here. As you'll know, my weekly updates are going to look on my YouTube, covering it week in, week out to say to people, we don't buy everything, but look, this is one which is, because we can't buy everything, because I can't buy everything. I don't have all the money in the world. Well, even if I had the money in the world, you'd concentrate it a bit. So that's where Netflix is. Now, somebody had asked us, well, what about Berkshire? You're more than welcome to. Okay, it's just that it doesn't grow as much as some of the others. because he's a cautious elderly man, which is fine for some. If it drops X, sell Y. Okay. As you know, we started also on the program putting in what the elite banks buy recommendations are, what the elite banks buy recommendations are for their wealthiest clients. So when Goldman Sachs Wealth Management says buy this, we then analyze it to see how they're doing. So Ravi and those on the program, I'll share some of these. So if Citigroup say buy XYZ stock, we'll analyze it to see, have we got the momentum? Have we got value growth income? Is it fitting? We're doing the same with hedge funds. So it's not just, oh, Alpesh, it's you and your database. No, it's not. The database data comes from those Nobel Prize winners in terms of value growth income. The data comes from the companies and the stock exchanges. But also we look to see, are there any hedge funds getting 40% per annum for at least 3 years? What do they hold and do they meet our requirements? So for instance, this one gets 53% per annum for the last 3 years because retail clients can't invest in hedge funds directly. So what we do is we x-ray the hedge fund and then we look at the data and we say, well, wait a minute, what do they own? And do we want anything that they own? Does it meet ours? And then we looked at this and we cross-referenced, what had gone on with hedge fund ownerships back in 2020. We'll look at what hedge funds own and see, do any of the things they own, and are they generating 40% per annum for the last 3 years? In other words, are they any good? And then do they cross-reference with our database? Only then we'll look at it. So if you look at this is old, so don't buy these now. This is an old slide from 4 years ago. Does it work? Hell yes. So he was getting 51% per annum for the past 3 years. These are some of his holdings. So we said, well, which ones of these reinforces us? So 3-4 years ago, we said, well, actually, that's good. That's good. Yeah. And you might say, well, wait a minute. These guys get paid that much money to pick this kind of stuff. Yeah, afraid so. I wouldn't necessarily do these today. I'm talking about when we looked at it then. We'll also cross-reference it with what billionaires own. And this is going back 4 or 5 years as well. And we'll say, oh, that's interesting. He owns a whole load of something which is on our list as well. Great. We'll buy some. Okay. Or right across all the biggest institutions and what do they own and do we want it? That's the S&P 500, and dark green means more ownership of a particular asset. Similarly with leverage, Ravi, you've done this on the program. It's new to you and it's worked well for us. Would I buy stocks today if I have 20% of my portfolio in cash? Yeah, I tend to keep 10% in cash and then I'm buying equities and exchange traded funds with the rest. But that's for me, Raj. I don't know your profile. I think, Raj, you might have emailed us yesterday, but your email was wrong. If you're the same Raj, because you've put that email address is wrong, so we couldn't reply to you because you'd asked us a question on performance and we couldn't. So when we did this is 3 years ago, and I mentioned leverage before. This is only for people who understand volatility. Otherwise, you will get handed your retirement in a plate, as in not a good plate, if you don't understand leverage. So, Ravi, you sort of toe dipped into this and then realized, okay, I get it, and I want to do it, and so on. This is old, so don't copy this today. What I'm saying is that's what we want, looks like, and so on. We'll also x-ray quality. We'll look at where the biggest multi-billion-dollar funds are buying, where they're buying stocks, because if they're buying them, supply and demand, they're pushing things up. And then we'll see, are they on? Everything has to be on here. Does it tick all the boxes here? And if it is, then we'll say, oh, actually, we've got this, or we've got that for argument's sake, or we've got this and we've got this. This is going back a few years. So, and then we'll say, yeah, okay, then we'll take it. Okay. We'll also look at what banks are telling their wealthiest clients. So this is going back, because when people say, does it work? Well, this is going back to 2019. And we said this will go from 42 to 70 when it was at 42. Because it was on our list. And of course, it did. Not today. Today means like several months later, because I'm pulling out old slides to show you, yeah, it works. This was Capri, and we said in April, that's what would happen in 2020, I think it was. And then a few months later, it generated a 250% return. Then you get the hell out of there because you're holding maximum 12 months. That's it. The point is, again, because we're cross-references, this is going back to 2020, I think. We said it, 2020, March 2020. We only hold for 12 months. We're not holding beyond that. Then it went to there. Today it's that. And then we do it again. Once 12 months are up, that was it. You're out. Okay, so there were lots of examples of this. It doesn't mean we'll hold it forever, because if you look at Uber today, you think, oh, do I want it or not? March 2020, so does it work? Yeah, okay, because we cross-referenced it, Firecom, and so on. Oh, God, there were loads. And we'll cross-reference it with cash flow. Is it on a discount cash flow? Undervalued. Why do we look at so many factors? Why do we look at value, growth, income, cash flow, Sortino, alpha? Well, because it's my son's inheritance. That's at stake. That's why. Simple as that. That's why. Okay? We'll ride the coattails of big money. Is it on the hedge funds? Is it on the hedge funds? And these are all the hedge funds we'll cross-reference it with. If it's not a deal breaker, but it's a tiebreaker. If something's on a lot of hedge funds who are doing 40% per annum and something else isn't, and it's on our spreadsheet, we'll go with the ones that are, okay? And we'll look to see volatility. We want to avoid things which in 20 days might drop too much, because nobody likes that volatility. So we'll do this. We do this from Wolfram Alpha, if you want to know where we do it from. Okay, Wolfram Alpha. And it's free. It's a free website. Okay, that gives us the database, and that's critical, right? I've already told you that. I've told you how these funds. Now, what I want you to do for New Year's resolution is, if you've got any funds with St. James's Place, Fidelity, 91, Bailey Gifford, Lion Trust, or Jupiter, ask your employer, look at their relative performance to their benchmark. I'm afraid it's rather worrying how poorly they perform, and then you make your decision what you want to do with your life and your pension, okay? Devax asked today, given its a report. Devax, I'm going to say what I would do is not what you should do, because I don't know you. I don't know what's suitable to you. What I would do, you know, I might say to you, Devax, I'm going to go jump off a bungee jump. Doesn't mean you're going to go do it. You know, as your parents used to say when you were little, well, if Alpesh goes jump in a well, are you going to go jump in a well? Okay. And that's really important, because it's got to be bespoke to you. And this is what I get across to all my clients. And this is the problem with fund managers. Fund managers shove you in a fund where you've got some people who might be psychopaths in there who are happy with that fund, and others who are very conservative people. But you're just lumbered in with everybody else. You're shoved onto a train with 3,000 other people who have bought into that fund, some with different ambitions than you, and so on. Why are you copying them? It should be, well, wait a minute, Devac, let's have a chat and work out what's the volatility you can take. Because if I put you on an F-35 fighter jet and do roll the loops and I land you safely, you're not going to say, oh, thanks, Alpesh, you land me safely. You're going to say, I just had a heart attack up there, mate. I'm dead. Okay, so this is a bit people don't understand. The reason they mess it up is because they get in. Let's say I said to you, yes, you get in. A week from now, you're vomiting into the loo because of the volatility. I'm all relaxed playing with my son because I can take the volatility. Do you see the problem? Now, there are solutions to that. You want gains. Of course, there's solutions to that. Risk and money management can be a solution, or finding an alternative product which isn't so volatile. Okay, and managing expectations of volatility as well by giving you the data and showing you this can happen. Then you've got an open-eyed decision. When people get blindsided and they don't realize, oh shit, I didn't realize that was as volatile as this. That's one of the problems. And one of the things that we're doing more and more is letting people know. Doubling money. How long does it take to double money? Well, if you invest in the UK markets, it's going to take you about 12 years because you're going to, at best, get about that kind of a return. It'll take you 12 to 14 years to double your pension. I want to try and do it in 5 years, and that's just a 15%. That's just 15. I should, with all my data and everything else, be able to do it sooner. But honestly, do I care whether it takes 4 years or 5 years to double my money? No, I know it in the end. And I'm a teetotal vegetarian. What am I going to do with all the extra money? I haven't got one child, and his mum's side of the family have got nobody else to get all the inheritance either. So he's got enough. Average positive return. That's why I said 32% is what I'm going to get over the next 2 years. Why? Well, I'm just going to say, I'm going to bet I'm not going to beat the S&P. Well, you're rubbish, Alpesh. Yeah, well, I'm going to say that, aren't I? Because it makes my life a lot easier. If I set myself a lower hurdle, then you guys can come back in 2 years and go, oh, wow, you're amazing. You met that really low hurdle. Whereas if I set a really high hurdle and say I'm going to double my money in 2 years and miss it, you'll go, you're rubbish. even if I got the same 32%. So I'd rather say I'm going to get 32% over 2 years. But I'm just cheating because of statistics. 88.5% of the time, that's what happens. So that's me. That's me. Okay? And I'm going to help other people work out what's right for them. Devak, they shouldn't all be doing the same thing. By the way, more risk doesn't mean better returns. This is where another thing people have got wrong. More risk doesn't mean better returns. Less, you can take more risk by crossing the road with your eyes closed and get run over. You took more risk. Did you get a better return? No. Instead, less risk just means less choice. It means you're going to have to work harder to fill your boots. Look at Warren Buffett. He's going into the new year with $1 trillion in cash because he wants less risk. We all agree on that. He's got $1 trillion in cash. We agree on that. But he wants the same high returns. That's why he's holding cash. It just means you've got less choice and it'll take you longer to find the thing suitable for you. It doesn't necessarily mean lower returns. And that's what fund managers get wrong. There was on LinkedIn, the head of T. Rowe Price, one of the biggest brokers in the US, saying to his daughter, well, if you take more risk, you'll get more returns. And I was like, well, go to Vegas then. There's the ultimate taking more returns. So he's basically taught his daughter, hey, sweetheart, go to Vegas because you'll get more returns. He doesn't know he's an idiot because they don't have the academic credentials. They're taught stuff on a multiple choice exam, which is 30 years too late. They're not taught behavioral finance. They're not taught what actually, well, first of all, they haven't been taught what reason why the economists got the Nobel Prize recently, people like Eugene Fama, because that's the cutting edge. Have a look at the reviews if you wish. It's very easy to open a SIP or an ISA. You don't have to use Barclays. I'm not affiliated to them in any way. You could use any broker, but you just go online. And the reason I put this slide up is more for my auntie's benefit. When I was 12 years old, she lent me £100 and I bought some bonds, government bonds. And to this day, she probably doesn't know it's this easy to open a SIP or ISA. I get some people are too scared to do it. But it is easy. She did actually eventually open a Hargreaves Lansdown account about 5 years ago. Watch out for this. Watch out for this. Is Financial Times. Give workers power to ditch pension schemes. It's not me saying it. I'm not a bloke on the internet trying to scare you. This is the Financial Times. Okay. They don't have a special axe to grind. And if you think they do, this is the Guardian, the left-wing Guardian. Right? Why? This is money, which is Daily Mail. So you got left wing, right wing, and middle, and then you got right wing again. So don't take my word for anything I ever tell you. I always say to people, don't take my word for anything. Go verify it yourself. Okay. Oh, well, it's the Telegraph. Can't trust them. Well, all right. What about the bloody Guardian then? No, that everybody's trying to scare you. I don't think so. I think there's something there. Okay, that these fund managers are screwing people up. And I know it because I get emails like this where people tell me, well, I've only got 20% in the last 10 years with Legal and General. But with you, I've got 20% in the year. And it's not because I came up with some secret stocks. It's not. It's just because I showed them how to open a SIP and an ISA and how to select better. Okay. That's what, over 10 years, that same person with 100K would have got if they just met the UK. They would have got 100 would have become 124. If they just tracked the NASDAQ, they would have got 482. Well, Alpesh, you said we should track the NASDAQ. No, that's not what I'm saying. I'm saying you should cherry pick companies which are undervalued with high growth. That's why these people, these fund managers get built up and they destroy your pension. They get built up. Bern, hi Alpesh, I'm on the verge of retiring and manage my SIP and ISA. What is the options to access your expertise? Bern, just email me, alpesh.patel@tradermind.com. And I'll give you both free and, if you want the bespoke service, the bespoke, but if you don't, I'll give you all the free resources as well. So just go to alpesh.patel@tradermind.com. That's Scottish Mortgage Investment Trust. These are the people who are the experts and destroy your pension. They dropped 50% in 2022. 50%. That's your pension. They manage pension fund managers. You tell me, 50%, is that acceptable? When I put that on Twitter, I had a bunch of IFAs telling me, oh, that's acceptable. That just happens. So not only are the IFAs stupid, they're lying as well. It's really worrying. Now, you might say, well, you're Johnny come lately, Alpesh. Well, no. 25 years ago, look at that date, 9/11, 1999. I have been switching virtually all of my long-term holdings from UK into US stocks. 25 years later, a quarter of a century later, the Financial Times, same newspaper, UK pension funds allocation to British stocks hits historic low. Yeah, because it took 25 years for people to bloody read my column, I guess. I don't know. Been on a mission for a long time. That's Blue Whale. They build them up. This numpty, that fund manager's all over the internet going, well, these are my picks for the next 10 years. Next year, for next year. And I'm like, mate, do you want to tell people, ask your IFA, how did you do in 2022 when we were having to hold cash? How did you do? Because if I do nothing for you than tell you once in 7 years when to hold cash, I think that'll be, well, bloody brilliant. Anyway, we will look at hedge fund ownerships, as I said, like this kind of stuff in all of that. If you want to see the performance of these things, you can have a look at alpeshpatel.com/shares. Yes, did we know Crocs was going to go up that much? Ravi, that was one of yours that you picked from the approved list when you first joined. No, I didn't, as I keep saying. We didn't know that was going to go up that much. We didn't know that was going to go up that much. So, because if we did, we would only have bought that and nothing else. That's why we had more than one stock, and that's why we got 54%, not 208. If we only had that, we got at 208. We got 54 because some of them didn't all go up 208% because we can't see into the future. We don't know how much something's going to go up. What we're saying is if there's a tailwind, these should do well, but there's no guarantee. Do you see how little we're forecasting? Do you see the subtle way, which I've said 2 years, 32%, because that's the average anyway. Do you see how I said how little I'm forecasting? Not how much something's going to go up, but that if there's a tailwind, these should do well. But even then, amongst them, one or two will fall. Not over-predicting, because if you over-predict, you're asking for trouble, which is why I'm as relaxed as Warren Buffett, and why, by the way, the guy's going to live to 100, God willing, because you're that relaxed. You had a job which was very relaxed. Anyway, if you want to see interviews with clients, alpeshpatel.reviews.com. This I've done before, so I won't keep you with all of this. That's the Goldman Sachs slide. That was the reason why we use cash rich on capital invested. What their research and development shows: companies with high CROCI generate 30% per annum returns on their stock price growth. Okay, not guaranteed, nothing's guaranteed, but that's why. Some great endorsements for my work from BBC, American Express, Merrill Lynch, Bernard from Hedge Fund, Coutts Wealth Management, as well, Financial Times journalist. Thank you, Peter. God bless you. So nice comments on my work. I like Warren Buffett's quote when he was asked by people, can I make a living in investing in the stock exchange? And reply, buy a tracker fund and go back to work. Oh, definitely don't ever leave your day job. And for most people, the reason he says buy a tracker is because most people haven't got the time, energy, effort, inclination, or anything else. And he's absolutely correct. But most people won't do that. What you've got to also recognize, which he doesn't, is most people don't have the patience to just sit. And also the danger with what he said is there's a group of people who say, like if I said to Ravi, just buy a tracker and go away, he'd say, well, wait a minute, Alpesh, why should I sit on a 26% loss when you could have just told me that average prices are dropping, could have saved me that? You see what I mean? So he's right. If you don't know who you're talking to, just tell them that. Okay. But if you do know who you're talking to, some of them, the tracker isn't suitable because they've actually got a little bit of nous and time and effort and energy, and they can do that. For my aunt, I just need to tell her, okay, put everything into cash this year. Rest of the time, I don't tell her anything. I don't tell her what stocks to buy or anything. I just tell her, here are the 20. I'll tell you when to go into cash. And every year I'll tell her, sell those, replace it with this 20. Sell those, replace it with this 20. And once in 7 years, I'll say to her, sell those, hold cash until I tell you otherwise. And then 12 months might go back, or 9, and then I'll say, right, now buy these 20. That's it. That's suitable for her. For somebody like Ravi, who's on top of the market constantly, he'll say, I want Broadcom. I'm going to do this. I'm going to do that. Do you see what I mean? If you don't know your audience, then go with the lowest common denominator. Like in maths, go with the lowest common denominator, which is, just have a tracker. But if you know your audience, you can say, well, actually, I know you, Bern, and I know what you can take, or you should do this, or Robert, rather. This might be more suitable to you. Here's an option, which is simple. It's got to be bespoke. Like a suit, it's your pension after all. Okay? If you want to know more, alpeshpatel.reviews.com. Merry Christmas, everyone. That's the day. What I want to do with my company. So when I set up the hedge fund, in 2004, and it was a Cayman domiciled equity long short. With it, you can only have institutional money in a fund. You can't have retail investors. What I want to do is make this into a FTSE 100 company by giving people the data and the know-how. Okay, and the know-how is through one-to-one communication. Basically, having a bunch of non-conventional IFAs, individuals who'll tell you how to do it with the data, rather than people saying, oh, pay me fees so I can manage your capital. So you keep hold of your capital, right, with whichever broker you want, and you have the data and the know-how, so you're in control of it. Okay, so it's only suitable for those people who want to have control. And I always say to people, join me if you want on the journey, on webinars. I give them a little discount. Well, big discount. And this is what we do. We evaluate the portfolio, come to the suggestions based on the data. They get access to all the database. They get access to the entire database for life, okay, and then we help monitor it for them. Speak to Paresh on alpeshpatel.com/links. He developed all the strategies for that hedge fund, and then we co-authored a book together in which he put all those strategies, actually in both these books, he put all the strategies for that. Actually, I think it's a $4 billion hedge fund now. But he set that up. That's how I know him. I know him through, because the founder of that's an old friend of mine. And so then we met. So we've been working together for a while now, actually, and we've co-authored some books together. So feel free to go to alpeshpatel.com/links. I'll make sure you get a copy of the books as well. Let me do that now. You should see some files that you can download, which are the books on there as well. If you want to join the program, more than happy. What I want to do eventually is get venture capital investment into this and then float it. Here's the rub. I'm not going to float it on NASDAQ. You need about $900 million in revenue to float on NASDAQ. I'm going to float it on the on London Stock Exchange first, because you need a lot less. And I met with them 2 weeks ago, the head of IPOs there. And the reason is grow it on, and this is what's going to happen with the London Stock Exchange, by the way, going forward. And I think it's actually a clever move by the LSE. They're going to take smaller companies. They're going to compete with the US. They're going to take smaller ones which are growing. And then once those companies become big enough, then there'll be a feeder to NASDAQ. Okay. And that's what they said to me. They didn't say the feeder bit to NASDAQ. I worked that out. So I'd rather set up smaller IPO, get the capital in, and then go to NASDAQ when we get more capital as we grow. So that's the ambition. So you'll get the data, all of the data, all of this as well. I'm going to answer joining. Thank you, Ravi. No, I'm so pleased. You've always been such a great supporter, and I'm really glad. I'm going to broadcast that to the room for all of this. And I'm going to see you in the new year. As well, Ravi, we'll be doing more events. Oh, that's the other thing we're doing now. We're doing more in-person events during the course of the year for Great Investments Program. I put it on the private Telegram channel. So we do 4 a year in Parliament, which is when I last saw you, Ravi. And then we're doing more lunches, dinners, coffee shop meetups as well. And we've now got an online community as well with people on the program. Okay, so thanks everyone. I've overshot again on this webinar, but I want to thank everyone. If there's any other questions, just email me. Just email me if there's any other questions. But I just want to thank everybody and wish you a very Merry Christmas indeed. Let me just see. Am I doing? Is there anything I'm missing? No, I wanted to wave at you, but I can't see where that bit's gone on here. So listen, thanks everybody. Yeah, delighted. Anyway, that's my ambitions for the program. I'm going to take for the first 350, and we're about, I think we've crossed the 300 mark. It was originally going to be 250, but I think I've got the capacity. For the first 350, they'll get me for life, and there'll only be a one-off cost in future, and the price is going to go up again because the stock market goes up. The price of the stock market, if I've got clients making hundreds of thousands in a year, guess what? Each year, the price goes up. So we're going to do that. Thank you very much, Vijay. Thank you, Carwin, Byrne, as well. All have a good holiday. Thank you all very much. And I will speak to you. I'm going to do 1 or 2 more webinars before the new year, just to look forward to 2025. So I will do more broadcasts, but I'll make sure I post it on Telegram and email you and all of this. So don't worry, you won't miss them. But I will do more broadcasts before the new year, because I think it's a time when people have got more time to look at things, and they're, and so I think it's a good time to do these things as well. So thank you all very much indeed. Thank you.